Alright, so I just want to start off with what SPY is. It's a stock that tracks the S&P 500 index fund, and that is a index compiled of 500 companies. And so basically what you want to look at here is the main component would be the holdings. So one of the first things you want to note is that the assets in the top 50, so the percentage of assets in the top 50 of this S&P 500 index is 52%. So that means that in the top 10% of the index holdings, that's 50% of the total index market cap. Okay, so that means that you have a pretty tight correlation of how these top 50 or more so, top 15 stocks are going to affect SPY's immediate movement. Okay, so that makes it easy for you to have a watch list going with, let's say, Apple, Microsoft, Amazon, Facebook, Google, Tesla, JP Morgan, Berkshire Hathaway, what you see right here. Then you can gauge kind of which way SPY might immediately move that direction intraday. Okay. So there are more large caps in the SPY or in the S&P index than there are in the Dow, and it's less tech heavy than the NASDAQ. Okay. It is also the largest and most heavily traded ETF in the world. It has a market cap as of April 30th, valued at $35 trillion. So that's huge, and it gives you basically a really good idea of where the market's tracking overall. This SPY, Dow, NASDAQ, they all move similarly and kind of track together. Yeah. Alright, so that's basically what SPY is, and for example, this is a 1-minute chart on SPY, and I would be trading these intraday movements, just day trading them. And to do that, you can see a few patterns here, which I'll go into more. These are wedges. To do that, you need to be reading the chart, drawing those patterns, recognizing support and resistance levels. Okay. So when I'm trading SPY, I'm trading option contracts, okay? And these are extremely high risk, and that's why, when I'm looking at the chart, I'm only looking at the 1-minute time frame or the 3-minute time frame or the 5-minute time frame, and I'm charting on these time frames because I'm only planning to hold these trades for, maybe even a minute, but as long as potentially I'm scaling in for 30 minutes and then I'm selling out, it's really only going to take like less than an hour. It's never meant to be held overnight, or it's not meant to be a swing trade. So that's why you're spending most of your time on these micro charts. What you also want to do is, first things first, you want to know the current condition, where it's at. So you want to look at the overall macro trend. And so you can gauge basically like if you do get a large movement or you're starting out where there's not a lot of, it's like morning open and you haven't seen the movement for today, you start gauging the larger overall trends. So I'm just going to draw a trend line here from bottom level and this is going to be pretty fast. Crude, potentially. And okay, so right here, this is one of those wedges I was talking about, but really at the same time, it's just a support and resistance trend line. So I'm taking, this bottom support level is also converging with this top resistance level, and until either one of these levels are broken, if it breaks up or down, they're both going to provide support and resistance. So overall, let's say on a day back in April when we hit, March and April when we hit this support trend, you can see it bounced and it ran to this resistance trend, consolidated there. Consolidation means, when it's not really moving in one direction or another for a certain period of time, often in like rectangle formations. Here's one right here. So it consolidated at resistance, and then it actually came back down to that wedge bottom again and bounced really strongly from there. So had you had this support trend drawn out, you may have guessed that if it didn't break and hold underneath, it wasn't going to break that trend and it would bounce from there. So that gives you an opportunity before it really dictates where it's going. You can say it's holding that level, so you start playing to the long side, to the bull side, and that would be the call contracts. So you're trading put and call contracts. So it's always good to just start with, looking at the macro trend. Okay, so I just want to break down like the main patterns that I'm looking for, and those would definitely be, wedge patterns, falling and rising wedges. So right here you can see the rising wedge, reversal pattern, or if it comes from a downtrend. So if it's in an uptrend and you see a rising wedge, that's a reversal pattern. If it's in a downtrend and you see a rising wedge form from the bottom there, that's a continuation pattern. But I mean, really at the same time, it's just a reversal pattern in the basic sense, because it's uptrending in this consolidation and then it's breaking down and reversing from that trend. Okay, so I really like these patterns because let's go into, I won't go into the chart right now, but you can play, or you can trade these small movements within the pattern as it's consolidating, or you can play the breakout of the trend. Okay, so then we have the triangle patterns, and you have ascending, descending, symmetrical. Okay, these are both continuation patterns and reversal patterns. Usually they are continuation patterns. So if you see an ascending triangle, usually it will break from the top resistance, and if you see a descending triangle, usually it will break down from the bottom support level, but you have to recognize that it can go either way. So that's why these patterns are great, to recognize where you're going to cut your position. If you're on the long side, you're playing calls. Say it breaks down here and you were expecting it. Okay, so say on this descending triangle you were expecting it to break down and it broke up. You could cut your put position, which is what you call a contract playing the bear side, and you could cut that there knowing that it just broke a consolidation pattern and it will find a new trend up. Okay, And then you have the symmetrical triangle, which looks a lot like a pennant. Can go either way. This one's more balanced than either ascending or descending, so I like to think this one can go either way a lot of the time. But unless you have a pole on it, because if you have a pole on it, so if you have a large spike up here before the symmetrical triangle, that is considered a bull pennant, just like if you were to have a large spike down from before the symmetrical triangle formed, that would be actually considered a bear pennant and would point to a continuation down, just like the bull pennant would point to a continuation up. So unless this has a pole attached to it, it can really go either way. Okay. So I just wanted to show you the rectangle pattern because this is just really a pattern that's showing you support and resistance, but it's also showing you that it will consolidate. And the thing about SPY trading is that you're trading these very near expiration option contracts, and you're heavily affected by theta and volatility. So you don't want to hold a position through consolidation. So you want to recognize these patterns and you want to plan your trade around them. So if I see a rectangle here with no pole on it either direction, then I would just be waiting for it to either break trend up or break trend down before taking a position. Otherwise, you would be trading within the pattern, just very small movements. And so this is why it's really important to get used to looking at really small time frames on your chart. Okay, and so this rectangle pattern is also what you want to recognize when you're looking for a bull flag or a bear flag. And a bull flag or a bear flag will be this rectangle pattern in a counter trend. I did not. So it'll be a rectangle pattern in a counter trend. So if you have a pole here, you'll have a rectangle pattern form counter to the pole, whether it's up or down, and that'll show you a continuation pattern, whether it's bearish or bullish. So the pole can come from above, and this rectangle would then point upwards, and that would point to a continuation down from the rectangle, whereas what you're looking at here is a bull flag. Okay, and then we have the cup and handle patterns. So I'm just showing you there are tons of patterns out there, and you can do a deep dive on them, but I'm just showing you the main ones that I'm looking for with SPY because we know that it's one of the most popular, or it is the most popular ETF there is in the world. So minding that technical analysis is all psychology. So if you have the most popular ETF, you want to be trading with the most popular patterns in mind. So this is the cup and handle pattern. Basically, the cup and handle pattern, you know, just like there's two sides to every trade, there's pretty much two sides to every pattern. So there's the inverse cup and handle. What you're looking at here is the cup and handle. So the cup and handle comes from a pullback and then a slow rise from that pullback, and then you have a downward sloping pattern or formation, you call it a handle, and that will show continuation up. Okay, and what else it's saying here basically that I want to touch on with all of these patterns is the length of the pattern, the length of time it takes for the pattern to form is actually going to carry weight in the strength of the move that comes from the pattern. Okay, so if you're looking at a really small rising wedge or cup and handle on a 1 minute chart, the move that you're taking that trade for is going to also be really small. And it's not going to take very long for you to open and close that position, or you want to be quick to close it at the very least. Okay, and then the inverse cup and handle, I guess it doesn't show a picture there, is just the opposite of that, and it shows a continuation down. So you have a rise at the beginning, and then you have the pullback come afterwards. You have the counter trend formation, and then from there you'll have it break the support trend in that handle and continue down. Okay? All right. So now you probably noticed the indicators that I'm using here, and if you haven't, I'm using VWOP, which is a volume weighted average price. Okay, and I use this because it is the most common indicator used, and basically all it's telling you is when you're above VWOP, the volume weighted average price, you're above where most of that volume is in the stock, so you're bullish, and when you're below it, you're considered bearish. Okay, Bollinger bands, so we have these two bands on the outer side, and these show volatility. So when there's a lot of volatility, quick movements, then you're going to see these bands widen. And when there's a lot of consolidation, like I was talking about earlier, you're going to see these bands tighten. And so the more it consolidates, the tighter these bands are going to get. Eventually that is an indication that you're going to get a move one way or another. And when these candles ride into the bottom or the top, you can see what happens right here. For example, it's riding the top band once it, okay, so it's riding the top band and it keeps going, it's strong. Once it rides the bottom band here, it's considered weak. If it had kept going, these would have gotten wider, but instead it held and continued to consolidate. Even though it's going up, it's still consolidating, not moving very much, but it is hugging this top band, and that's considered strong, so it's still consolidating upwards. Now you don't get these bands widening until you get this drastic move down, and this is in March 2020, so we all know what happened here. COVID. Alright, so you get that volatility in the bands, and then so basically these are almost buy and sell signals, so that's how they're considered for a lot of people. So if you see it holding the bottom bands, and again, these indicators, they change on all time frames, but if you see it holding the bottom band, that's an indication that it is going to regain its strength. Okay, but if you see it having a more harsh interaction with that bottom band, that's an indication that it's going to continue weakening. Now, there's three bands here, and one is a lot more steady, and that is actually the 20 SMA. So it's called the middle band, middle Bollinger band, and it'll also change on all time frames. And so the 20 SMA is another indication of, you know, if a stock is bullish or bearish. It's the 20 simple moving average, and so it's over a 20. It's a short time period. There's the 50, the 200, the 20. The 20 is a short time period, so it's a medium term, basically, indication of strength or weakness in the stock, and it again changes on all time frames. And SPY really, and the traders on SPY really respect these indications. I've found with Bollinger bands, and I have it on 20 length and then the standard deviation 2. Okay, and then I'm also using RSI, which is Relative Strength Index. And that just basically shows you whether it's oversold or overbought, depending on the time period you're looking at as well. Now, it's not, none of these indicators on their own are perfect. That's why you use a combination of them. I like to use RSI and Bollinger Bands together because they honestly seem cohesive on the chart. And you can see when this is interacting with the upper band, this is also oversold, and it'll be that way on, overbought, sorry, and it'll be that way on every aggregation period you're looking at, whether it's the daily or the 1 minute or the 3 minute. All right, and then we also have volume, and that's obviously a very key indicator, especially when you're looking at these 1 minute time frames. Or 3 minute time frames, these small scale time frames. You can see whether it's consolidating up and the volume's weakening, or you can see whether it's gaining volume, and you can see that per candle. So that's a really good indication, because if you see it break your trend resistance and then gain volume over there, you know that buyers are potentially coming in because of that resistance break. Okay. So really with SPY, what you're doing is you're fighting your own emotions and consolidation, because these are really small moves that you're looking for, and you can often, it goes against your trade, and you can not cut that position in time, and these contracts are 100% risk out the gate. They can expire worthless. You can take it at the wrong time and it will be down 40% in the next 2 minutes, and you don't even know what happened because you weren't looking at the screen. So you need to be sure that you're planning your trades really carefully, and that's why we touched on these patterns. Obviously, another thing you're gonna want to do is support and resistance. So I'll touch on that in a second, after I just get into planning your trades a little bit. So you really want to avoid consolidation, because that's just going to eat your contract premium for nothing, for no reason. So you want to recognize these trends, because these patterns and these formations, that's where SPY is consolidating. So if you want to play the breakout either direction, you want to wait for these. You want to scale in so that you're not sitting through consolidation as much as possible. And how can you do that? Let's just quickly look at an example of these wedges over here. And I just plotted some arrows for you, okay? And I just did this quickly before I started the stream, but this would be a fairly quick trade, okay? And you would be, so there's two different patterns that you're looking at here. You're looking at a falling wedge and a rising wedge. So we're ignoring the falling wedge here. A play from here would have been calls going to the long side. But we're going to look at this rising wedge, and first you want to see it confirm a resistance trend. So we're starting it here, and you want to see it confirm that with a rejection here. So you get that, and then you get more confirmation of that support trend converging as well with a higher low. Okay, so then you get that rejection. We're not going to do anything yet, but you get the second rejection. That's when you're going to, take your starter position. You get a little bit of consolidation here, and then you're going to add to your position on the break of this trend. And then we also go under the mid band on the 1 minute chart, so you know that it's getting weak on a small scale. Okay, so you're going to add to your position there, and one more time, we test the mid band. If we go over that, you know that short term you're over that 20 SMA and there's a bit of strength. But it is rejecting here on the third candle, you know, add another put. Let's say you're in full now. That's 3. That's an easy way to do it. 1/3 at a time. I personally do 1/5 at a time. But let's say you have 3 there. So now you've added on the rejection. You're in a full position. And why would you sell that position on puts here? Well, because this could be considered a double bottom. Okay, so that's one other pattern or trend we're looking at is the double bottom trend, and there's double bottoms, triple bottoms, quadruple bottoms. You know, for me personally, the more you see a support level tested, the weaker it is becoming, and same with a resistance level. Anyhow, this is a double bottom, which is obviously considered a bullish trend. It's just one retest of that support. If it holds, it likely bounces. So you can see it holding in a few candles here, and it's also holding lower Bollinger Band, so you could sell around here or here. But remember, these are very small moves, and each candle represents 1 minute, so you're really only sitting in this position for maybe 20 minutes from when you started scaling to when you closed it fully here. Okay? And then why would I start a new position here? I might use just profit, take a small position because this could be considered a double top from this resistance level in the wedge, right, to this level here. Okay, so if it doesn't break that double top, then it's still weak and in a downtrend. So you might take another position on puts there, and then you see it holding lower Bollinger Band, curling towards mid band, so might just sell right there just in case it were to gain that mid band back. If you miss profits, you know, it's not the end of the world. I'm just looking at a quick trade here. But again, you could also consider that you're still holding under VWOP and you might be taking a longer trade. Okay, so I'm looking at these are small trends. Just a quick, you know, rising wedge trade. You close it, you reopen some profit, you ride it down on a double top, and then you close that. Now you can reassess depending on what, you know, you want to do there. Okay, so I guess I will just quickly touch on support and resistance. It is important on these 1 minute time frames to also be charting support and resistance, as well as on the larger time frames, because on, like with the patterns, the length of the support and resistance trend is going to determine the strength or the weight that it holds. And if you guys can't join this stream, I am going to be uploading it to YouTube. And you can find us on King Street Trading on YouTube. Okay, so I'm going to zoom out a little bit here, just get a better idea of the overall movements. So I just drew that. Basically that's a rectangle. Like I said, that's really just support and resistance. Okay, and you can see that once it breaks that support level, it begins downtrending. Okay, so you're combining. Now I'm going to combine this previous support level, and I'm going to recognize that it is now holding resistance, and it's combined, it's under VWOP. So here you could take a nice long trade on puts. So you could start your trade at resistance because it's safe. Well, not safe. because it's a cheap starter, actually taking puts at resistance, not safe. There's a potential that it's going to break out and move against you. You have to have a tight stop loss there, or just be ready to mentally have a tight stop loss. Okay, so you could take a starter as you see that it's consolidating at resistance, and especially after this sell-off and this rejection here, that's very, very strong. Straight from upper to lower. Didn't even test mid-band to hold there at all, so you can recognize that's very weak. You get a retest of upper Bollinger Band. You're not going to get all the way to resistance necessarily in this channel, but you get upper Bollinger Band. You take your starter position here. Okay? Now you're seeing it test support, double bottom, failed to break out here, potentially a double top, right? It's a double top. So you see it coming down. You can either take your position, add to your put position on the double top, failed VWOP breakout, or you can add to it on the, well, let's zoom in here. Or you can add to it when it retests. And I would like to add to it when, I can recognize a consolidation pattern. And that would be this rising wedge as it's retesting support or previous support, which is resistance now, and VWOP. So there's a lot of pressure there for selling. So I would add to my put position there and continue riding that down, right? So that's just using that support level as previous support as resistance. So now we're going to find our next support level, and to do that, zoom out a little bit. That's why I like to use these. I don't extend it all the way across. I use these levels and just place them where the action is that I'm looking at, so that I know where it is in reference to a more larger scale. Okay, so finding that next support level, I'm gonna look at this resistance level that it broke, and it's close to the bottom of this wedge here as well. So I'm going to say, hey, before it even finds support, I'm going to draw a potential support level there. So as it's downtrending, I see, okay, it might have support here as well as it has that wedge, right? So let's go back to, on the large 1 year, 1 day chart. So now I've drawn that support level from a previous resistance level on SPY. And you can see it consolidates there, and as well it's actually consolidating right on the wedge there. Okay, so that's where you want to sell your put position. Once it's finding support, it's going to start potentially reversing from there, and that's going to go against your puts, and as soon as the stock moves against you, your profit is eaten away immediately. So it's really good to have. You can use a trailing stop loss as well. Just ride the profit out, and then once it comes back 10, 15, 25% from where you had that profit, you'll stop out there, or you can intensely watch that chart, which you should be anyways, and gauge where that support is being found and close your position fully manually yourself. So I kind of had some notes here that I just ran over, so I'm gonna hop in here and ask if you guys have any questions. All right, so that's a really good question in general, and that is, when buying SPY options with a small portfolio, would you recommend buying more out of the money in order to be able to scale, or do you recommend, well, let's just touch on the first question there. And while it is really a benefit to be able to scale, those further out of the money contracts, they have much higher Greeks working against them, and like theta, and it's going to be a lot harder for you to hold those positions while you're scaling. So I would recommend using a higher premium and closer to the money contract. Maybe find some middle ground there. Never go too far out of the money. If you can use 2 contracts at the very least to scale, 2 or 3, that is ideal over using 1. But try and stay close to the money, especially on 0 days to expiry. On 1 day to expiry, you have a little more flexibility with that. Okay, let me, so go through what I'm thinking bar by bar is what someone just asked me. All right, so how do I get rid of that? Okay, sorry, I just started using TradingView here. All right. So, for example, with that last trade, let's say we took a pretty slow position on puts and we rode this whole downtrend under VWOP. Market closed. Which time is this? I believe. Okay, yeah, this is Eastern Standard Time. Sorry, I'm Pacific. Confused me. Okay, so we're gonna close our position before end of day, and let's look at the next day here. So for me, morning open, on this day, if I got up and saw this bull flag, or not even, is this a bull flag? This looks like a ascending triangle here. So you would see this ascending triangle with that pole, which signifies a lot of strength, and you would want to take a position in calls here, potentially for a morning open play. So I would want to be getting my calls cheap. So going through candle by candle, you can see this just spikes up here, and then you get a sharp rejection here. Now once I see it holding a support trend line right here, you know, I would take my starter on calls. And then, so let's go with that. Let's say I'm using 1/3 at a time, so I have 1/3 of a position on calls from this green candle here after it consolidates up on support. Now, if I saw this break trend, I would get out of that starting position. Okay, but since it's still holding trend here, I'm waiting for a well, okay, so we actually do see it break trend here, and basically it would come back to your entry price and you'd see it hold VWOP, and you could add on to your calls there again, and then you see it break that resistance and hold above there, and you add on to your calls again once it holds above the resistance there, and then you recognize the previous support level being right here, and that's kind of where your initial target is for this call position, and you could just sell right there, right on the spike. That's what I would do personally, just because I try to avoid consolidation at all times. Now, once we get up here, you can see you have another resistance trend line there, and you have another support trend line here. Okay, now this is a pretty, it's not a very large wedge, but if this support trend breaks, you could see a potential move of weakness, and so you'd want to, we just sold calls. You could trade calls through this consolidation up, or you could wait and get puts. Now, I would wait and get puts, recognizing that this is going to consolidate, and I'd rather just get a strong move quickly down, do a quick put position. So I would scale in on these rejections of resistance. So let's say right on the third candle here, I'm taking my starter position. That's the second rejection. And then I would add right there on the third rejection, and then add on the retest of that and the rejection, maybe at mid-band there, and then full position, sell out there. Now it's finding support above resistance here. So again, really small movements. So that you just sold calls there. You probably wouldn't even want to take a large position in this, just like one or two, and then sell calls. Sell your puts. Now, here's an interesting one here, because with you don't always have these patterns play out how they're expected. Okay, but here you can see there's actually a bit of a cup and handle right here, and you might expect it to continue from this cup and handle, but it does not, and it breaks down. So you can play puts on that failed cup and handle continuation, and that is another way to be observing these trends, is not just for playing the trend, but also playing the potential failure of that trend. Okay, so one good question is, if you have pattern day trading restriction, you can't do many day trades, I would just say, take advantage of one day to expiry, because the closer the expiration, the greater these fluctuations in premium price on the contracts are. So if you're trading the same day expiry contracts, you're going to want to have many trades, lots very quick. Or if you don't want to overtrade, you will want to have very quick trades, because time is working against you. But with one day to expiry, you have a little more room to scale in for larger moves. And so if you don't have the ability to trade as much as you want to, I would just take advantage of those one day to expiries. So I scale in typically either in the 1/3 or 1/5 range. Okay, so I'm either taking 1/3 at a time, or 1/4, or 1/5 at a time. Okay, so repositioning is basically when the trade you took and you planned for, let's say if I'm you know, if I was trading that cup and handle, there we go. If I was trading this cup here and expecting it to handle out, and it didn't, so I had calls on it, and it dropped, I would rather have my stop loss trigger and take that loss on my position, whether it be 5 to 15%, rather than just averaging down on calls. Because say, you might not be the perfect trader. You might, take calls, you see it break, and you average down right here as it's falling. Okay, well now it's going to keep falling, and you're going to keep getting your position taken down. And yeah, it's just a lot more risky than just cutting the position and reassessing. Okay, I always prioritize repositioning than averaging down, because once you average down, these contracts, they go from negative 15% to negative 75% in a matter of minutes. So if you start averaging down when you're down 10%, and then you start averaging down again when you're down another 10%, soon you'll be down potentially 50% and down a lot more. All right. So basically, I have a video on support and resistance, but all I'm doing with that here when I'm drawing these levels is I'm looking at these candles, and I'm trying to intersect these levels with as many wicks or candle bodies as possibly, preferably candle bodies. The reason I did this wide trend here is because it's showing more of a rectangle pattern consolidation. But if I were to go in, and you should always go and zoom in on these 1 minute charts and draw support and resistance, I would be looking at these candle bodies. Let's get this thing out of here. Be able to see, right here you have a previous resistance level which broke out, and that's also considered support, right? So we're going to draw a level there. Now we have another support level. Okay. Now let's find our next resistance level. So if we're trading in this support level, our next resistance level is going to be right here. Okay. And you can just get that from this consolidation itself right here. And if I just go over, it's right there as well. So that's going to act as a support level. If it breaks out, it's going to act as a resistance level, and if it breaks over, it can hold support, and now you get to test resistance. Now with that failure to break out of resistance, you're going to get added selling pressure. You have the mid band right here lining up with this previous resistance, now trying to hold support. Both fail. Now you get a lot of weakness. You get a bounce off of VWOP and support to resistance, right? Market close now. But yeah, so you closed at resistance, and we opened, at a lower support level back on that actual channel, which was, again, the longer period of time it was holding, so it held more weight, and once it broke, it held more weight as resistance. Okay, and so you saw the downtrend intensify. All right, any other questions? All right. Yeah, so I kind of touched on that with the question about being, if you have a small account, are you going to be using out of the money? I always actually try to stay within, uh, 2 strikes of the current price, just as a general rule of thumb, because if you're further out of the money, that volatility and the time decay is really working against the premium, which is a lot cheaper. And if you're closer to the money, the premium is just more expensive, and those ratios to the Greeks are a lot more negatable. So that's why I choose those ones. And yeah, especially, another thing with these strike prices is when you get to the end of the day and you get a lot of volatility in a short time frame, like a power hour, I actually start to go in the money, especially on 0 day to expiry, because those get a lot less affected by the volatility. One way to take advantage of out of the money contracts is if you're looking for a very small scale move, you know that fluctuation is going to be a lot higher on the out of the money contract. So if you're looking at a small wedge like the ones I have down here, and you're just trying to trade this small trend here, you could take a further out of the money contract, and you'd get a lot of your contract would increase a lot, the premium on puts, if it were further out of the money on that small, quick, volatile move. And if you guys have any more questions, I think I pretty much covered. Basically, what I'm doing with SPY is I'm trading the contract premium. So I'm not exercising these contracts, and I'm only doing it for, depending on, you have Monday, which is same day expiry, you have Tuesday, next day expiry contracts. Then the following Wednesday is same day expiry, and so on, right? So you have 3 same day expiry and 2 one-day expiries. And I'm just trading these small movements on the 1-minute scales, intraday movements, trading the contract premium. And so the whole idea there is you want to make sure that you're trading the setups and the odds are in your favor, and to do that you need to cut your losses. This is one of the most risky forms of trading. It certainly gets rewarding once you practice this technical analysis, but until then I'd recommend paper trading it, because you can lose so much money so fast, especially if you get emotional and you're not used to day trading. You really need to be able to recognize when the trade has not gone your way, and you take that loss, reassess, are you going to flip sides, or are you going to wait the consolidation out? You really need to be planning your trades for this, and you need to be actively monitoring. And I do SPY scalps every single day in our chat, where I'm analyzing the chart live, pretty much, because I'm always throwing updates in the chat, and I trade. I alert my trades for you guys as well, and I'm always there to answer your guys' questions. This is for our King Street Royal membership, so you're welcome to sign up for that if you're not already on it. But I just wanted to give you guys a good start to get started on your own, and give you an idea of how you do it. Yeah, so when I gave you that bar by bar analysis, I would be inclined potentially, but because that pull was a lot larger, I can't find it anymore. Where did it go? Okay. Yeah, so because you have this pull here, this could just be a flag, right? So maybe I had the pattern wrong, but this pull is pointing to a continuation pattern in the consolidation here. Also, with this candle where it broke that support trend, you're holding VWOP, and you get a strong candle off of that mid band in VWOP. So maybe you don't add until you get the confirmation of the resistance breakout, right? And then you get a strong move there, and you sell your call contract. So yeah. So the indication would have been, holding VWOP generally is bullish, as well as having that large gap up into open. You're very welcome. If I didn't say what the question was, it was just I had an ascending triangle there and it broke that support trend. Would I not be inclined to cut a position on calls? And I was just breaking down why. Just because of that, I wouldn't. All right, so can I talk a little more about my price targets for taking profit and my stop loss? Are they mental or physical stops for me? Well, for me personally, I've been trading SPY for every single day for over a year, and I've set my rules so when I first started out, I had very hard stop losses in place, and that was usually in the 5 to 15% range when I was already in a position. Once you have a little bit of experience and you're actively monitoring your positions, you can just mentally use your mental stop losses, because you can use those market orders, or you set your stop loss, stop limit just based on where you think that contract premium will be at that given time frame. That's not the best way to do it, but yeah. So I personally take profit really quickly. I'm looking usually for, depends on the day. If it's 0 days to expiry, I'm usually looking to start taking my profit at 20%, and then start taking it, at 35%, and then start taking it at 50%. So I scale out along the way, and then I'll add in depending on the trade, right? But usually I'm pretty happy with 20 to, 20%, 50% in that range. On 0 day to expiry is a good profit taking for me, but on 1 day to expiry, I'm actually only looking for 5 to 15% and compiling those small gains on 1 day to expiry, and you can do that pretty much all day. So I'll actually be I'll have 2 different contracts open, for a longer trade and one for a shorter time frame trade. So I might be adding on dips on calls on this longer trade while I am scalping puts within the wedge on or within a consolidation period on a shorter time frame. Okay, so I'll have 2 sides open, potentially just completely different trades and plans behind them. Okay, yeah, I'm happy if this is helpful for you guys. And I do this, I can answer you guys' questions anytime in the SPY chat, which is for our subscription there if you guys aren't a part of it. And I think unless you guys have any last minute questions to drop me, give you guys a minute. Alright, so I'm just going to quickly tag you guys if you want to ask your questions. Something I didn't touch on was level 2, and that is something that I do use is another indication of buying pressure or selling pressure, really. And I can't really go into it because I'm using my trading view, but you guys should really, especially if you're on Thinkorswim, which has level 2 for free, look up videos on reading level 2. It's a good indication of short-term pressure. Like I said, someone just asked if I swing SPY, and like I said, these are all day trades because I'm looking at these very short trends, and those are the trends that I'm trading. These contracts on these very near expiration contracts, they have time decay like you wouldn't believe, and if it doesn't go your way, which you can't control overnight, and you have no, you don't know what's going to happen in the news, if there's any catalysts. It's just not worth losing all of your money by swing trading something you have no control over. So when I'm drawing these patterns, really, a lot of the time I'm using wicks or bodies. Doesn't really matter too much. So if I'm, what matters is that there's a constant repetition of testing trend, like there's no trend line there, but it's just if it's making higher highs or lower lows, or, it just has to have that continuous repetition. So another, you know what, I should have said this at the beginning, I don't know how I didn't write it down, but there are wedges like these, like this is a rising wedge, and then there's a broadening wedge too. And I had those, so this is a broadening wedge here, so it's basically an inverse wedge, and it's neither really a reversal or a continuation pattern. It does show a lot of indecision between buyers and sellers, so these moves could keep getting larger, more volatile. If it breaks one way or another, so typically it is actually a reversal pattern. This one here is descending, so you would probably see it go and break up. And you can see where I'm drawing these trend lines from. So this one I drew ahead of time, so I'll just delete it. So I'm just looking at this here, and I can see that, you know, these formations where it's dropping and rising, they're getting larger each direction and each time. And there's like a resistance trend from this drop here to here, right? So I'm gonna take my trend line and draw from that candle. And it's not perfect because it touches and these break through. Right, okay, so there you go. On that candle body there. And then the next one be from here, and you get multiple points of contact there. So that one's really clear. Okay. So that's kind of just really you're just seeing the retests of trend. So if it comes down and it holds there, that's a trend line right there in of itself, and then you see that that trend line continues there and it continues here. So that's basically all I'm looking at. So I'm using volume when I'm looking at, you know, these breakouts and consolidation. So if I'm looking at a weakening consolidation in a rising wedge, for example, and then okay, you know what, here we go. You can't see my hands, I'm doing all these hand gestures behind my screen. So if this has weakening volume here, right? This is just an example because it's not a perfect scenario for what I'm explaining. And then if it had weakening volume on its consolidation upwards, and then on the break of this support trend, it had, you know, an intense volume and an increase in volume. Like you have here, you can see on the volume here, it increases a little bit there, and you get some large drop-offs there. So that's where I'd be looking for volume analysis. I use RSI. I definitely use RSI, but I'm using a combination of all of these indicators, pretty much balanced. Like if I were to pick one out of any of them, it would probably be Bollinger Bands. Maybe volume second, so it'd be Bollinger Bands and volume. So I guess that's that, but all right. If there are no more questions, I see one person typing here, so I'll let you type, but after this question, I'll probably call it. So I'm just gonna, while you guys are typing, I'll just oh. Of course. I thank you for everything, man. Thank you for taking the time to teach. I am very happy to do this. I don't often do these public streams, so I just wanted to do something for you guys. And yeah, happy to do it. All right, so it looks like that's all. Looks like that is all the questions for tonight. So thank you so much for joining, and I hope this, gets you started on another path. Potentially trying a new strategy, because, this really, every single day, being the most traded ETF in the world, has a ton of liquidity in the contracts. This is a really good thing to practice consistently trading, because it's there in any market condition.